Excellent. Thank you very much and welcome all. This is already the third of our What ESG Investor Want series, a set of events targeted at our corporate clients to give you some really direct feedback around the priorities and strategies of ESG-focused investors. Today's topic is the UN Sustainable Development Goals, clearly an incredibly important framework for societal development. I'm incredibly pleased to be joined by again, a fantastic panel of experts on this topic. And we have Willem Hettinga from APG. We have Sheila Whitley from the PRI, that's the Principles for Responsible Investment. And thirdly, we have Del Anderson from PIMCO. In terms of the format, for the first probably around 40 minutes or so of the session will be moderated by myself, and after that, there's the opportunity to ask further questions. Indeed, raise your hand or ask a written question for the panel. Three topics in particular we'll be going through. Initially, the SDG Investment Approach from the panel members. Then the views around the SDGs and their suitability, and finally corporate reporting around the SDGs. So with that, let us kick off. On the SDG Investment Approach, perhaps Sheila, beginning with you. The PRI produced a report on investing with SDG outcomes back in June. Do you mind summarizing the key recommendations of this five-part framework?
Sure, Arthur, I'd be happy to, and thank you so much for including us in the panel today. I'll try not to go on too long, but I thought it was useful to speak through each part of the framework in turn. As Arthur mentioned, the Principles for Responsible Investment published a report on investing with SDG outcomes in June this year. This was to respond to growing signatory demand for support for those signatories who are keen to invest in line with the SDGs. So just quickly to go through each part of the framework. The first part of the framework is about identifying outcomes. So that's about investors seeking to identify and understand both, what might be intended outcomes, but also unintended outcomes of their investments and of their own operations. This assessment involves looking at both positive and negative real-world outcomes, and thinking about this in the context of operations and products and services. Now, this can build on existing activities that some investors and companies are already undertaking in terms of mapping existing investments or activities or portfolios to the SDGs. And in some cases, there are investors who are looking at the scale of investments aligned with the SDGs, but this is taking it to a next step. So it's taking it in many cases, these mapping exercises are at the level of the goals. And the key here is really to take it to the next step in terms of looking at specific outcomes. And that means looking in the context of the SDGs at targets and indicators and focusing on that level of targets and indicators where progress can actually be assessed. The second part of the framework is setting policies and targets. So this is where you move perhaps a kind of a mapping or an identification exercise, which might be a kind of state of play towards actually taking intentional steps to shape outcomes or aiming to have impact. And policies and clear targets are key for this. The third part of the framework is then thinking about, well, what can individual investors do to shape outcomes and to take action on those targets. And what we focus on there and where we kind of elaborate examples for our signatories and other investors is, how already are investors using three key levers: capital allocation, stewardship of companies and investees, and then engagement with policymakers and other key stakeholders to shape outcomes in line with the SDGs. And those key levers are again, sort of cut across the whole framework. It's really thinking about, what are the tools that investors have that they can be using to shape outcomes. The fourth part is then looking beyond the role of individual investors and then thinking about the financial system. So the role that individual investors might play in shaping outcomes at the financial system level. So there are two main ways that we would look at this. It's thinking about, how can individual investors play a role in thinking about how we look at collective progress. So that's where you would have engagement around, standardization processes, where you have, standardization of reporting and in terms of expectations. It's also the place where you would look at collaboration. So where we have, where this is sort of perhaps most well known for our signatories is around collaborative engagements. But there are many ways in which investors can collaborate on stewardship activities, but also can think about perhaps, activities around and investments in the context of blended finance. So, bringing public capital and private capital together. And then the last piece, and where we would argue, or the last part of the framework, and where we would argue, real change happens in line with the SDGs, is really only when all stakeholders are acting to drive progress on particular SDGs. That's where investors can be working alongside NGOs, businesses, and governments. And we see this, just for a couple of examples, we already see a lot of this activity on climate, and we're starting to see it on other issues, social issues such as modern slavery, where you have multi-stakeholder initiatives that should be shifting investment away from negative activities and towards positive activities. So I know that's a bit, hopefully it wasn't too long-winded, and I'm happy if you have any kind of follow-on questions from that.
That's incredibly helpful, and I think you said very well the holistic nature of the steps that investors, but both unilaterally, but indeed also multilaterally, can take. And perhaps turning to Dell, clearly at PIMCO, one of the world's largest fund managers, what are the tangible steps that you've been undertaking to really use SDGs to influence your portfolios?
Definitely. So, Del, I understand I'm a credit analyst with PIMCO. I cover banks and insurance companies as a fundamental credit analyst, and then I also lead the integration of ESG in our credit funds for our ESG platform. And what I could say on that is it is challenging in many ways to use SDGs as a guiding framework for, let's call it, listed public companies, because listed public companies have a whole kind of range of activities that they engage in. However, on the credit side, when we're looking at the use of proceeds for individual bonds, and we're looking at how is a company using financing to guide its investments on an incremental basis, that is where we really see the SDGs as a primary guiding framework for the impact and outcomes of the company's investments. And so in our own ESG platform, and we're thinking about ESG investments, we're really looking at companies to utilize the SDGs as the framework by which they communicate their own impact, measure and evaluate how they're using their funds toward a positive environmental social impact. And I would say since 2015, we've been building out the ESG platform, and since 2017, we've really been focused on incorporating the SDGs as the guiding disclosure framework for companies when they're showing and demonstrating to the market how they are having an impact with their own financing. And when we look at reporting externally, the SDGs are the guiding framework by which we evaluate that reporting. I'd also note that in the past we've highlighted the opportunity for SDG Bonds, and over time that has really been adapted and kind of encouraged by the market. And ICMA, who is the primary, I guess, guiding body that has the green bond, social bond principles, has done its own mapping to the SDGs. And so when companies are coming to market for green, social, or sustainability financing, we now see very clear mappings between the SDGs as well as mappings to the targets and indicators that they are aligning their use of proceeds on the bonds that they bring to market.
Perfect. Thank you, Del. I think we'll turn to SDG bonds in a few minutes as well. But first, Willem, of course, APG, you manage money from major pension trustees, be that the Dutch government, be that education employees. I'm guessing SDGs are probably quite relevant to many of your end clients. What are the kind of questions and directions that you're getting from them?
Yeah, thanks, Arthur, also for the opportunity to contribute to the panel. But yes, indeed, we receive questions, and the funds receive questions from their beneficiaries. I think above all, I think we have a clear mandate from the pension fund clients to invest in line with the SDGs. I think already in 2016 we started out with the first work to map the SDGs towards how can we actually invest along the lines of the SDGs. To date, so in 2019, end of the year, we're almost close to 60 billion of investments in those SDIs, as we would refer to it. And also last year, ABP, the biggest client, announced to revamp it up to 20% of their total assets in 2025 will be invested in line with the SDGs. So that's companies that contribute to their products and services towards 17 SDGs. That is a target which is across all asset classes. Also, as Del indicated, there's nuances per asset class, so to say, of what works best. But this is a generic approach that we apply. And yes, participants are growingly interested to see how their money is being invested. Also, under the new Dutch pension contracts, they will be made more aware of how investments are made. And particularly in the fixed income space, I think green bonds and labeled bonds are a very powerful investment instrument for us to invest in, but also as a way of communicating to the end beneficiaries about how we actually positively contribute to the SDGs. So I think all in all, if we look at SDG alignment, I mean, the world is still a very dirty place, let's be honest. And we actively seek to contribute towards transitions. And I think the key is that these SDGs are really a global language that we talk, and it's a global language about the solutions that we actually need and see for the future. So that's in a nutshell of how we approach it. Thank you.
Fantastic. Thank you, Willem, and also Willem, you touch on labeled debt there, and perhaps Del, turning back to you. PIMCO has indeed been very, I think, articulate in calling for more SDG aligned bond issuance. Could you perhaps elaborate on how you define that universe, I guess, both from sort of a use of proceeds bond perspective and from this new generation of KPI linked bonds? What do you look for in terms of SDG alignment or targeting?
Absolutely. And I think Willem had some good points. It can be challenging for an investor in a public company to really get a sense of what they are funding if you're putting it into a general corporate purpose vehicle, which is your typical unsecured corporate bond. However, once you have a labeled use of proceeds bond or a sustainability linked bond, where there is a clear connection between the funds that an issuer is borrowing and what they are planning to use those funds for, that is when you can actually connect the SDG goals, targets, and indicators back to a specific amount that has been lent by our clients through our funds, or from a company, what the purpose of the funds they are borrowing is going to be allocated towards. And that is a very powerful connection, to your point, when you're thinking about SDG financing gaps, when you're thinking about how do you actually fund a carbon transition. People want to know, what is this company going to be borrowing the money for? And does it have any objective, positive climate or social value? The SDGs are that language, and they enable us to make those clear connections. And then over time to also be able to track what was the impact that the company achieved through the outcome metrics that are also reported alongside those bonds. We can talk in depth about some of the new types of bonds that are coming to market. that's not the in-depth topic of today's discussion, but there's also sustainability-linked bonds, which don't specifically require they're linked to SDG targets. That is our recommendation when we work with issuers. We would like to have issuers that they're setting high-level corporate sustainability targets, given that the 17 SDGs have been pretty much globally recognized as the primary indicators of sustainability. We would want companies, when they're setting their own sustainability targets, to also ensure that their targets are consistent with the goals and the indicators. And toward that end, having bonds that fund positive progress along the SDGs is really an excellent way, both for companies to ensure that they're having a positive impact, and also for us to ensure in our reporting and our own assessment that we can aggregate those impacts across an entire portfolio in a way that's valuable to our clients and our investors.
Thank you, Del. And clearly on the topic of SDG alignment and strategies, there's an incredible data and perhaps AI exercise as well. I know, Willem, from an APG perspective, you're involved with a number of cross-fund manager initiatives. Do you want to comment on the kind of tools that you're using to go through portfolios and determine SDG scoring, etc.?
Sure, yeah, happy to do so. I think when we started out with mapping positive investments, I think we started in 2010. And I mean, we linked it to the green categories, right? Renewable energy, energy efficiency, pretty straightforward in that sense. And then in 2016, with the SDGs, I think the scope was expanded to include social a lot more. And I think the need to come with some kind of taxonomy grew, because I think, yes, it's a clear agenda, 17 goals, but if you have read through them, I mean, they're still pretty generic, and there's sometimes inconsistencies or balances between which are tricky. So we partnered up with the other Dutch asset manager, PGGM, on mapping those 17 SDGs of what is investable for an asset manager like us. So we came about with a whole taxonomy and guidance about how companies actually contribute to their products and services, that's the key entry for us of how we employ SDGs, so to say. This year, we have launched together with two other asset owners, that's Australian Super and BCI from Canada, the SDI Asset Owner Platform. So it's a collaborative platform of where we maintain and further expand the taxonomy that we initially built together. So I think this is where definitions come into play of how we look at what is really contributing to which particular SDG. So it's an asset owner platform, but I think the link there is that we have also employed Entes, which is an artificial intelligence company, to run our rules and our assessments across the entire universe of companies and come with a mapping about which companies contribute through their products and services. So revenues is quite key here. So it's a pretty objective criteria of how we look at this. The product is also commercially available in that sense. So any subscriber it's free for all subscribers to get these classifications as well. I think what we try to create is some level playing field of how we, as bigger asset owners, asset managers, look into how to translate these 17 SDGs. And I think this platform is also necessary because I think the SDGs are never final, right? And sustainable development is always enhancing. So what's today might be different from tomorrow. I think that's why it's important to collaborate together on this, because it's a route that is still evolving.
Great, thank you, Willem. And I think that's a very good bridge to our next topic of discussion, which is the SDGs themselves. And Sheila, I mean, this has come across in a number of the answers that the SDGs, just the bottom line formulation of them can be a little bit opaque, maybe hard to directly invest into. But what kind of work are you doing within the PRI so that to better formulate targets and really to act as perhaps a bridge with investment strategies?
Yeah, it's a good question. And yeah, some of the other speakers have highlighted some of the challenges already. I think before the stage of formulating targets, and this is, could be equally true for companies and investors, it's really thinking about and deciding on which are the most important sustainability outcomes, for that actor. So I think we see at the moment in this this outcomes or impact space, there's quite a lot of attention on climate, and I think if you were to do a survey, you might find climate at the top of many lists, and that's of course driven by emerging regulatory frameworks, but also potentially beneficiary priorities. There are other tools for thinking about important sustainability outcomes in the context of social issues. The UN Guiding Principles on Business and Human Rights specifically takes investors and companies through a process where the aim is to look at the most severe impacts to people from business activities, and that's another way of thinking about what are the most important outcomes to look at. There could also be, as I mentioned in the case of climate, there may be, and I think some of our signatories have undertaken surveys with beneficiaries or done internal consultations across their organization, and then it may be, particularly in the case of companies, about looking at key sectors and geographies and thinking about key outcomes from that perspective. So once the most important outcomes are chosen, then, as you said, it's about looking to set targets. And I think what we would emphasize is that these targets should be set in the context of global goals. So as I said before, this is about looking below the level of the goal at targets and indicators. But as others have said, not all of these even targets and indicators speak to a specific threshold. Some of them are, I think someone used the term sort of generic. So some of them are vague about actually what the end goal is. And so in some cases, this is sort of where there's a role for investors and businesses. It may be about clarifying those expectations. It may be also about engaging in processes where those expectations are being set. So, that's going to be in the context of biodiversity. There's new global agreements being reached. That's about, what's the clarification of expectations if they don't exist clearly in the SDGs, or they don't exist clearly, in the Paris Agreement, or in the context of human rights through the particular conventions linked to human rights. So that's a key role for investors. For PRI, we're looking at this specifically through a number of areas. So in the first instance, on climate, we're part of kind of co-convening the Net Zero Asset Owner Alliance. And they have a draft right now of a target setting protocol that we've been part of developing, and that's out for public consultation. We've also been very much involved in supporting our signatories to implement the EU taxonomy, and we have a number of case studies and guidance around that in terms of resources. And we're also kicking off work around social data. Social data is one of the big gaps. And so we have a Driving Meaningful Data initiative that's going to look, across the SDGs, but also some of our initial work is really going to be focused on social data and data that's relevant, for human rights issues.
Great, thank you, Sheila. Another issue some raise is that SDGs can be slightly inconsistent in terms of the best course of action that individual SDGs can give guidance on. For instance, you can have zero poverty, and you can potentially deal with that with certain intensive farming methods, but that would be very harmful to a number of the environmental-oriented SDGs. And I think that Del, you were also commenting earlier around companies are complex organizations with lots of different activities, which may have pluses and minuses for different SDGs. How do you try and deal with I guess such inconsistencies, Del, when trying to form a holistic picture through the SDG lens?
So the SDGs are an excellent guiding framework for impact. They're not the only impact framework that we look at, and they're not the only ESG evaluation framework we look at. So if I'm looking at a company as a potential investment, either for an ESG fund or a non-ESG account, we want to do a holistic assessment of the company's business profile. Then does it have positive or negative ESG characteristics? There's a ton of data that's available on that. And one of the key things we look at is what is the company's senior management's attention to sustainability? How are they governing their own sustainability targets, both from the setting to the measurements and then the subsequent reporting? And do we think that they are setting challenging, incremental, and additional targets that are, I guess, more aggressive than what their peers are doing? And that's a core part of our ESG assessment for a company. And so if you think about it from a medical perspective, first you want to do no harm when you're investing in a company. You don't want to have an aerospace or call it lethal weapons manufacturer that's bringing a new low carbon transport bond, something along those lines, because they're doing some pretty negative things potentially elsewhere in the business. Or when you're evaluating a tobacco or alcohol producer, if they're improving the sustainability of their water sourcing, that's great. Or potentially they're improving the living wages or the pay level for some of their suppliers, we would absolutely support that. But we also have to look at what's the core underlying business, and to the extent that there are negative externalities in the business, we also need to incorporate that into our investment decision. In some respects, the Sustainable Development Goals give us a language and a framework for thinking about positives and negatives. And so if a company is performing particularly poorly in a way that has negative performance along those SDGs, we also want to be tracking that and reporting that when we're thinking about the balance of positive impact for that investment, regardless of whether it's a SDG or green bond. We're thinking about that from a total company perspective, and we have to think about the positives as well as the negatives when we're making such investments.
Thank you. And turning to Willem, and you mentioned earlier, Willem, at APG, you have been running an SDG taxonomy for a number of years. I guess quite curious, amongst the 17 SDGs, have you noticed particular skews or prioritization in that process?
Yeah, thanks. I think overall what we've seen over the last 5 years is the move towards more social. That's in frameworks and regulatory as well. But I think it's good that we see an uptake of social bonds as well, where especially last year with COVID, I think a lot of COVID relief and social bonds came to market. So I think the S of ESG is putting more central in RI and ESG investing in general. Overall, I think the SDGs are pretty comprehensive and very overarching. And earlier this year, also ABP announced that they are going to focus on 3 key transitions, and that's energy transition, climate change, that is resource scarcity and circularity, and that is digitalization. So particularly, we are interested to see how investments in companies that address these transitions and thereby achieving the SDGs or partly the SDGs, those investments would have a particular interest. Having said that, I think there is still plenty of possibility and opportunity and challenge to reach all the SDGs. So maybe we also can't afford to become too picky in that sense, because I think if we want to achieve them, with the right standards and with the right scrutiny, I think we need all of them going forward. So that's a bit of a mixed message. But in terms of communication and work that we explicitly undertake to get new investments, these 3 focused themes are quite central to how we run it.
Great, and it takes us to the final segment here, which is really focused on the corporate reporting around SDGs. And Sheila, earlier you referred to the importance of specific outcomes, and I know the PRI that does work regularly around SDG case studies as well. What role would you say case studies and examples play as part of a company's overall SDG narrative?
Yeah, so this is a bit more, I guess, focused from our side on investor sort of disclosure and not so much around on corporate reporting, but they're obviously linked. So I'll try to make the connection. So yeah, we do have a rolling series of case studies on investor practice that we're putting together on investor practice on investing with SDG outcomes. We had a kind of first series that looked at stewardship activities and engagement. And now we're looking a little bit more closely at capital allocation, excuse me. And in particular, we have another report and a series of case studies that look at this in the context of private markets and infrastructure investing. So that might be of interest to the audience. Now, kind of in line with what I've said before, a lot of the focus and even the case studies that we've managed to find where investors are looking, as I've said, sort of below the level of the goals and at targets and indicators, and where they're looking at those in the context of global thresholds. Really, there's the most activities in this space linked to climate change. So that's on sort of reducing negative outcomes around fossil fuel-based energy supply, and then also on investments in, let's say, renewable energy or energy efficiency. So there's several good case studies on that. In terms of other SDGs, we have a case study from Nomura, which is focused on health, and one on a service provider called Global Impact Partners, which is focused on affordable and sustainable housing. We also have some case studies on this process, as I've mentioned before, which is on how you identify priority SDGs to focus on, although taking Willem's point into account that we need to work on all of them. But we've got a case study on CDC's approach to prioritizing SDGs, and then rolling out an approach across the whole of the CDC, and also an approach that AP2 is developing around looking at its entire listed equity portfolio and identifying those severe negative human rights impacts across a listed equity portfolio. So those are those case studies should be quite useful, and are part of what we're going to now be introducing questions on outcomes into our PRI reporting framework. And so we hope a big part of that is voluntary reporting by our signatories, but we hope it will generate more case studies and more experience to share with others.
Great, and I'll just remind the audience, if you'd like to view those case studies, go to the website unpri.org, and as you say, Sheila, there's some I think very interesting read across for the corporates, for the sell side as well, in understanding how investors are looking to highlight their SDG strategies. Del, and you referred to this earlier, you clearly have to look at a wide variety of companies and organizations from an SDG perspective. I'd love to hear any best practices or any sort of companies, if you want to call them out, that are particularly effective in this area.
Sure. Before doing that, I wanted to follow up on one additional point last time, saying, how do you manage inconsistencies between SDGs, and what about companies if companies aren't addressing all of them? And I do think some of the SDGs are focused much more on macro and country level of progress, and particularly in emerging markets, which can be a challenge if your primary investment universe is large S&P 500 kind of public companies in the US or in Europe. And so there's a natural alignment of certain SDGs to the activities that companies typically undertake, and particularly the types of investments that companies make. Others have already highlighted climate change as a key area. We look at SDG 12 and kind of improvements towards circular economy. We're looking quite a bit at, and more recently, at quality education as areas where companies are starting to come to market more frequently with SDG aligned investments. And you can always find companies that are working toward improving their biodiversity and their environmental impact for life on land and life below water. So those are some of the areas where there's a natural alignment for companies to be investing incrementally in their own businesses, and that's where we tend to see most of the activity The other areas will often be more of the screening, where we try and identify if a company is doing harm. Say if they don't have an appropriate diversity on their board, or if they don't have gender diversity, those are the areas where the company could actually get marked down for poor performance. When I look at corporate reporting that's come out to date, before just highlighting individual companies that do well, I would say consistent with what I had mentioned earlier, we look for companies that are setting challenging and incremental top-level targets that are consistent with their business strategy. So if a company is involved in the transportation space, say an auto manufacturer, making a long-term sizable commitment toward electric vehicles, or battery production, technology improvements along those lines, energy distribution for powering those fleets, all of those things we would view very positively and as having a positive contribution. So setting the targets is important. Making sure that there is an audit or a validation done internally by the company, or ideally externally, is also something that we look for. And we want to see the companies are doing all of this consistently and achieving targets over a longer time frame, and communicating those results in depth to investors. And that's a key part of the process for our ESG accounts, is we want to actually see individual project level details on the impact, that they've chosen appropriate frameworks and outcome measures, and that they're reporting those at a level of detail, so that we can really get a sense of what the company is doing and how it's made a difference. So finally on that, companies I think we are seeing deliver along these targets recently. On the European side, I would highlight Telefonica, Tesco, a food company in the UK. I would highlight Enel among utilities. They've brought a SDG linked bond here in the past year, and additional bonds subsequently. And there are a number of banks that are also becoming more advanced in their SDG reporting. And I think that's an area that's growing very rapidly among financial institutions.
Thank you, Del. I'd like to think that includes NatWest as well amongst those banks.
You guys are getting better. You guys are getting a lot better.
Thank you. But perhaps to conclude this section, Willem, when we're speaking with companies, the concern of SDG washing does come up in terms of throwing sort of all of the SDGs in a report to try and make as broad a statement as possible. How do you find the right balance between the number of SDGs to align to, not too many, but also not too few?
Yeah, thanks. SDG washing sounds really negative, and I don't know if that's really the key concern, but I think a lack of focus certainly doesn't help in that sense. And clearly the way we look at it is that we look at the company's revenues into product categories that we list or not list. I think at least if that disclosure is out there, you can have a fair discussion with issuers and companies about to what extent your ideas differ in terms of how products can contribute to the SDGs. So I think first and foremost, the transparency is important. And yes, we don't expect every company to contribute to all SDGs. So there's no need to be as broad as possible. So I think focus is important here. Also because, we look at it at the product and services level, right? And the conduct of a company, also as Del indicated for PIMCO, yes, of course, we address it through different frameworks and mechanisms that we have in place. So I think the SDGs are purely meant and put out there as a way to guide the solutions that we need. So I think also in bringing labeled bonds to the market, focus is important. Sometimes we see pie charts of use of proceeds that then also include a minor category about, electrification of their own car fleet, which is good and which is appreciated. But if you look at the real impact that company may have, it might not be through the conduct of how they run their their leased fleet in that sense. So for us, there's no need to have the pie chart in as many colors as possible. And I think focus is good. At the other hand, we of course need benchmark size deals, and we also appreciate the fact that you need some flexibility there as well. So it is a balance between having a focus that is clearly aligned with how you run the company and what's aligned with the corporate strategy, versus enabling the market to also participate in the issuance that you put to the market.
Great. That wraps up the moderated part of the session and indeed the recorded part.